Okay, welcome. This is going to be chapter 13. It's our last chapter. All right, chapter 13 is about retirement savings. So this is relevant for everybody and should be especially interesting for you guys on the financial planning track. Here's a PSA for you. Be like Kylo Ren, wears a mask, doesn't visit his elderly mom, socially and emotionally distant, talks to his girlfriend only on Skype. Here's a news story from 2018. The story says, Romney hit a certain age, 70 and a half, forced to take a $1.7 million IRA withdrawal. Right, so after this chapter, you should understand what something like that means. All right, this is interesting if you want to read through it on the slides. So we had a similar example on the first day of class, right, where we supposed an investment, right? You pay your taxes, you have some savings left. You put something in, let's say for 30 years, you're going to earn an 8% annual return, and your marginal tax rate is 35%. So at that rate, after 30 years, right, if you pay tax on it each year, and when you pull it out, you'll have $22,879, right? Pretty good. All right, but if you were able to invest pre-tax income at that marginal tax rate, that $5,000 becomes $7,692. And if the earnings accumulate tax-free, at the end of 30 years, you should have $50,311, right? So more than twice as much, right? So the point is taxes can make a big difference in retirement savings and investing. So our retirement stuff is going to be happening from a tax perspective, right? The tax advantaged retirement provisions work by either letting us take some money out of gross income, excluding it, or getting a 4 AGI deduction, right? Which basically accomplishes the same thing, right? Either way, that money is not in AGI and it doesn't get taxed times our tax rates. Ways to save for retirement, right? Most commonly, people will have a plan that's sponsored and administered by their employer. People can save on their own, right? And government transfer payments, right? Meaning the government will collect Social Security taxes from current workers and they'll pay them to retired workers. Notice that all of these systems are one way or another based on tax, right? Part of the US tendency to do most of our policy through the tax system. Here's a non-tax retirement method. Uncle Eddie says, that's from when I sold my kidney. Smartest thing I ever did, Clark. Sold his kidney for money, buried it all over the yard. Okay. When we're talking about employer-provided plans, we'll talk about qualified plans. A qualified plan means it's eligible for tax benefits that we talk about. Primarily being when the employer provides the benefit, they can deduct it currently, but for the employees, right, it's not taxed, it grows tax-free, and it's only taxed when they get money in retirement. To be a qualified plan, you can't discriminate between employees. Congress basically wants to make sure that if a company is going to get tax benefits, they can't just provide retirement to the top executives. They have to provide it broadly to all employees. There's two main types of these plans. There's the defined benefit plan and the defined contribution plan. All right, in either case, if it's a qualified plan, right, the company, right, can deduct the accrued liability. If it's not qualified, they could only deduct an actual payment to a retired employee. So defined benefit plans, we're just going to discuss that on this one slide. All right, from the tax benefits are there because from the employee's perspective, their benefit is growing tax-free, and they'll have ordinary income when they retire and receive a pension. All right, but the employers get to deduct their liability currently. Early distributions are subject to a penalty. All right, so defined benefit plans are nice from the employee perspective because all the risk is on the company, right? If investment returns are bad, they still have to pay the same benefit to the employee. All right, because of that, oh, Chief Wiggum says, that's a shame. He had 1 day left till retirement. All right, because of, right, companies don't like bearing the risk, right? These pension obligations, especially as people have less children and people live longer, pension obligations have become very expensive. So there's been a shift towards defined contribution plans, right, where you have to contribute a certain percentage. The company will usually match that in some way. All right, that money grows or it doesn't. The risk of investment is on the employee, right, as to how much then they're going to get when they retire. Right, you usually have, right, some leeway as the employee of what kind of investments you want the money to go into. So you've seen, right, common types of these are 401k, 403b for nonprofit, 457 I think is for government employees. All right, so this is very, very common and important. So with our rules that we're going to go through surrounding these defined contributions plans, you can think of them as being kind of like a piggy bank, right? The rules are ensuring, one, they want deductions to encourage people to save, but Congress also wants to protect their revenue. So they put a limit on how much you can contribute each year, right? So that's kind of like the piggy bank. It just has that little slot. It limits how much you can put in at one time. All right, but we also know, right, people, we're going to want to spend the money now. And so, right, that's why the piggy bank traps the money inside. We want to make it hard to take out until it's retirement time. So we have penalties, right, if somebody takes the money out too early. This one doesn't really fit my piggy bank analogy, right? But we also have what we call minimum distribution requirements. Eventually, the taxpayer has to take the money out and pay tax on it, or there'll be penalties, right? Because the Congress does want to get that tax money eventually. So the limits on how much you can contribute to a defined contribution plan like a 401k. For 2019, it's $19,000 for the employee. Once you're 50 or more at the end of the year, we have what we call catch-up contributions because you're getting closer to retirement and you're panicking. You can do an extra $6,000, so $25,000. The most that the employer plus the employee can contribute is $56,000, or $6,000 more than that, $62,000 if the employee is 50 by the end of the year. All right, but it also can't be more than 100% of the employee's salary that year, right, or their total compensation. So you can infer there, right, that we'll do an example and you can see these numbers. Dave contributes to his 401k account. His company is very generous. They'll match an employee contribution 2-for-1. So Dave's 32 at the end of the year. He contributed $19,000 to his 401k. How much would his employer contribute? All right, so normally they would match 2-for-1, which would be $38,000, except that would put them above the annual combined limit. So his employer can only contribute $37,000 to bring him up to the $56,000 combined max. Right, well, without that limitation, they would have done 2-for-1 and done a little bit more. So if Dave earned a salary of $85,000 during the year, what's his gross income? I feel like Dora the Explorer. I'm talking to a screen asking you to respond. Okay, so if his salary was $85,000, his contribution comes out of his gross income, right? So it gets excluded, doesn't even get counted, right? So he won't ever pay tax on that contribution. And the $37,000 that his company put in is also not part of his compensation. Oh yeah, right? It's a big tax benefit. What if Steve contributed to his employer-sponsored 401k? His employer also matches 2-for-1. Steve is 52 years old and he contributed $23,000. His employer will contribute $39,000. Right now, because Steve is 50 or older at the end of the year, the annual max is $6,000 higher, right? So they can go up to 62. His employer would put in 39. If Steve's salary was also 85,000, what's his gross income? Right, that his contribution comes out of his gross income, and the employer match is also not part of gross income, right? So that's a total of $62,000 that's not getting taxed until he starts to get withdrawals in retirement. Oh yeah. What if Steve, right, still 52-year-old Steve, what if he contributed $30,000 to his 401k account? Okay, now we see he's gone over the max, right? The most, even being 50 or older, the most he could do was $25,000. Right, so his gross income, right, he can only exclude that $25,000 max. All right, and so his gross income will be $60,000. He has until, right, the tax filing deadline, July 15th for 2020. If you guys saw that because of the virus. All right, to fix that and withdraw the over contribution. If he doesn't, he's still going to be taxed on that $5,000 now, and he'll be taxed on it when he retires and withdraws it. Here's an interesting story that the book pointed out is one place where defined benefit, right, pensions are still popular is with somebody like Jeb Bush. So when Jeb Bush, right, was running for president, he released his tax returns and revealed that he has a pension and profit sharing plan for his little consulting company. Right. Well, there's only two members. It's an LLC, and it's him and his son, Jeb Bush Jr. Right. But by paying Jeb Bush, by paying himself a pension, he's allowed to make very large deductions. Right. He deducted one year $350,000, right, that he could exclude, rather than deduct from his income. All right, because if it's a pension, he's allowed to contribute as much as it takes to fund the liability. And since he's close to retirement age, that's a very large amount. So this is perfectly legal, clever thing that tax people figured out to make very big exclusions and pay to retirement accounts. All right, so vesting means, right, so you've put money in, right, your employer puts money in. Vesting means at what point does that money really become mine so that I can't lose it? All right, if it's your own money, right, that you contributed out of your salary, it's yours immediately, right, and you can't lose it. If it's the employer match, what they've put in for you, there's different ways you can do it. It could be a 3-year cliff or a 6-year graded schedule. Or if the employer wants, they can be more generous than that and they can have it vest sooner, but this is the minimum that they have to do. So a cliff means you're not vested at all until the end of the third year. Then after 3 years, you're fully vested and all the contributions are yours if you leave that job. A graded schedule means the employer contributions gradually get vested by the end of 6 years, they're yours. All right, so when sometimes you see that on TV where someone is 1 day away from retirement and they get fired, usually, right, they're still gonna be entitled to their benefits. All right, so if you have a defined contribution plan like a 401k and you're retired and now you're getting distributions, that money, right, it's avoided tax this whole time. It was not taxed when you earned it and it's grown tax-free, but now each distribution you get is taxed as ordinary income. An early distribution, right, this is our piggy bank analogy. You're not supposed to take it out early, is going to give you a 10% penalty. So what is early? Early means you're still working and you're younger than 59 and a half at the end of the year, the tax year, or you're retired, but you're younger than 55 years old, right? Right, you got caught with your hand in the cookie jar, there's going to be a penalty. Some plans will have exceptions, right? There's certain financial hardship things that could allow you to take a distribution without the penalty. Talk more about that in a second. Starting in 2020, Congress recently passed a law that says you can distribute up to $5,000 for the birth or adoption of a child with no penalty. Let's assume Lisa is 57 years of age and still employed by her company. She requests and receives a $60,000 distribution from her 401k. What amount of tax and penalties is she required to pay? Assume her marginal tax rate is 24%. All right, so when Lisa gets this money, is she subject to a penalty? Yes, because she's not retired and she's not 59 and a half. If she was retired, then she would not have a penalty because she's more than 55. But because she's still working, she has to be at least 59 and a half. She's going to pay that $60,000 distribution times her marginal tax rate, right? Even if this wasn't an early distribution, she still has to pay ordinary income tax on it. Plus, she's going to pay a 10% times the distribution penalty of $600. So $20,400 total, right? That's adding up to 34% tax on that distribution. It's going to be pretty painful. Right? If you're watching the news, Congress passed a big stimulus bill. Hopefully you're all getting a check. Part of that bill you may not have seen waives that 10% penalty this year, right? It's pretty broad. If you suffered any kind of hardship from the COVID-19, you can distribute up to $100,000 from your retirement account, right? Your defined contribution plan, and there's no 10% penalty. It's still subject to ordinary income tax, but you sort of have this 3-year window where you can either pay over 3 years or put the money back in and not have a tax. Okay, required minimum distributions. Starting in 2020, this age is 72. 2019 and earlier, it used to be 70 and a half. That's why we saw that Mitt Romney story. He turned 70 and a half. He started having to take out distributions. All right, so once you reach that age and you're retired, so if you're still working, right, if you're not retired, you don't have to take a minimum distribution. But if you are retired from the company that sponsored that plan, you have to take a minimum distribution, right? So let's say 2019 is the year that you turn 70 and a half and you're retired. By April 1st of 2020, you have to take your first distribution. All right, so the first year you can delay until April 1st of the next year. But right in 2020, you'll have to take another distribution for 2020. 2021, you'll have to do a distribution for 2021, and so on. So what is the minimum distribution? It's a percentage times the balance in your account. If you're supposed to take a minimum distribution and you don't, you have to pay a penalty, right? It is very harsh. 50% times the amount you should have taken out but didn't. Right? Congress has let you defer tax this whole time, right? But they want you to take it out eventually, because if you remember the Steve Jobs example, right? The money that you leave when you die, right, may often not be taxed to the people who receive it. So Congress doesn't want this money to never get taxed before you die. That's why we have these minimum distributions. So a percentage that we get is going to come from an IRS table, right, our uniform lifetime table, where the IRS predicts how long we're going to live. Ricky Gervais used to have a podcast with Stephen Merchant and Carl Pilkington. And I remember one time Carl came up with an idea. He wanted to invent a watch that didn't tell you what time it was. It would tell you how much time you have left until you die. Right. So this is the concept here behind this IRS table. So let's look here. Let's assume Steve retires in 2019 at age 71. Also assume, right, so in 2019, 70 and a half is the age. Starting in 2020, it goes up to 72. Congress changed it. All right, so since he's retired and he's 70 and a half, now he has to take a distribution for 2019. The balance in his account was $2 million. All right, so we've got to take that balance and we have to find a percentage. So since he's 71, I'm going to look back here. His distribution period is 26.5. So let's pause here. What we're going to do, a calculator, we're going to take, right, 1 divided by 26.5 to get a percentage. That's going to be 3.77%. That's how we got that. So we're going to take his balance at the end of the year times the percentage we got from the table, and it's going to give us a minimum distribution of $75,400. Because it's his first year, he has until April 1st, 2020 to do that. I give him an extra time to figure that out, right? The idea is hopefully when he's filing his taxes, his accountant will spot that and avoid the penalty. But then by the end of 2020, he has to take another distribution for 2020. And 2021, he'll have to do distribution, etc. What would happen if Steve didn't make the required minimum distribution? He's got to pay the minimum distribution times 50%. So he'll pay a penalty of $37,700, right? So it's very harsh. All right, so let's stop there and then we'll break chapter 13 into one more video.